You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. How are you doing today? Today we're going to talk about the dividend growth slowdown among some utilities. And no, I'm not talking about Algonquin that cut their dividend for a second time this year. Once in 23, once this year. But I am talking about two of my I would say favorite, but not necessarily favorite in the sense that I don't have I don't invest in Emera, and I have a very, very small position on Capital Power for my Smith Maneuver, which was a pretty good timing when I bought. But two utility companies that I like, that I think has a very good business model, very stable, mostly focusing on regulated utilities, which is great because they have a territory where they pretty much have the monopoly over there, and they deal with regulators to increase their rates. When it's done properly, it's done very well. Both companies focused on having a well-diversified debt portfolio, so their debt maturities are spread across many years. Most of it is fixed, so that is super important. We saw that with Algonquin. And it leads to kind of boring but very stable business models, generating a lot of cash flow, and of course paying a dividend that is great with a good yield and a decent increase that will match inflation. Well, that was true for both of them, where their target dividend growth rate target was 6% per year, and then both of them decided that this year they will change that. So let's start with Capital Power, CPX. So CPX was guiding for 6% annualized growth rate for the dividend, and then they changed that to 2 to 4% per year. So one thing I like, though, is their target payout ratio was also reduced to be a target between 30 to 50%. So at a 30 to 50% payout ratio, you can be 100% sure that the dividend will be safe, which is great. I mean, not 100%, but you get the point. It's a very solid payout ratio. The 2 to 4%, not the end of the world in the sense that it's still going to match inflation, which would be enough in my taste if I was looking for utilities. And if you have already Fortis, that is the mother of all utilities with a pretty solid dividend growth history, I guess it's really hard for others to replicate that. So for Capital Power, they have a huge capex. They have been into a lot of projects as of late, lots of acquisitions, and I think it is just the time to digest everything, making sure that they can still continue to grow the business and think about having a solid balance sheet with higher interest rates as well. Even though the interest rates are getting cut this year by Bank of Canada, we're not going back to 2020, 2021. So the free money is still gone, and whenever they will renew maturing debt, it will cost more than what they have right now on their balance sheet. So it's a good news that for them that interest rates have slowed down, because at least they will pay a little bit less, but still that interest charges will continue to increase. So for Capital Power, I think it was a very solid decision, and actually it was appreciated by the market as well. Since the beginning of the year, total return for CPX is up by almost 21%, slightly beating the TSX 60. So pretty solid, but most of it happens since June. So over the past 3 months. So the rest of the year it was pretty much down. At one point it was down almost double digit, and now it's up 21%. So you can see how fast things could turn. But yeah, so I'm just thinking they have a lot on their hands right now. They have invested a lot in acquisition. They are in that transformation where they're getting out of all coal productions. So that also cost a lot. So I think it's just like a good move. As for Emera, another one with a dividend growth guidance of 6% through 2026, just announced about a month ago in August during their recent earnings that they would now go for 1 to 2% increase. That's not much, right? That's below inflation. I mean, best case scenario, inflation's at 2%, and best case scenario, Emera is growing its dividend by 2%. So I don't really like that. Again, my sense of feeling is prudent management. The kind of like the party is over. So Emera has recently announced that they will sell for $1.2 billion their Labrador Island Link. They will use most of the proceeds to pay down debt. So smart move here. Most of their CapEx is still in Florida. So Florida is definitely a growing state. With a lot of potential for Emera, but yes, they need a lot of money and they are willing to invest in the business instead of increasing the dividend. So in the meantime, I mean, Capital Power is paying like 5.7, so almost like 5.6 at 5.7% yield. Same thing for Emera at 5.6. So you get a pretty decent yield, but you're not going to get much growth. So what does it tell us in general? Well, it tells us that the party is over. Easy money is gone. It also tells us that those management teams think forward. They'd rather be prudent, which I appreciate, especially thinking that most people that would invest in utilities are income-seeking investors, likely going to retire or retired already. They count on that income. So I rather see management thinking about the future of the business and maintain the dividend, but it's still not a good sign overall, right? Because if you don't get much dividend growth, you're exposing your retirement income to inflation, which could be bad, especially if you have those companies in a taxable account. Well, then the dividend growth rate will not be enough to cover for inflation. Keep in mind that utilities are not supposed to grow super fast. They're not supposed to report like double-digit returns year after year. They're supposed to be a little bit more like deluxe bonds. So companies that you don't expect much from the stock price appreciation side, and you just get a decent, good yield, like 5-6%. Without having much more than that. So as long as the dividend grows along the inflation. So for Emera, I'm definitely disappointed by that. If I had it in my portfolio, I would seriously reconsidering it because of this too. So not a big fan at this point of this announcement. It's just like one bad metric. You have to do your due diligence, look at the entire financial statements to see if it's still a good fit to your portfolio or not. But it's just a reminder that you should not be complacent about your portfolio. So it's not because a company have been great for you and increase their dividend that it's going to continue forever. And with that in mind, I would like to invite you to my next webinar at moosemarkets.com/webinar. So next week, we are going to talk about how to manage your portfolio and ensure that your income at retirement is generated by your portfolio, that is sustainable, that it's easy to do, and that you can retire stress-free. So we're going to take a look at how you can manage through announcements like this, like Capital Power and Emera, how you can shape your portfolio in a sense where you're allowed to make mistakes and it's not going to kill your retirement plan. So go to moosemarkets.com/webinar. It's a 100% free webinar. I'm going to stay there for at least an hour to answer all your questions. That's going to happen next Thursday. And if you cannot watch the live event, you should still register, because if you register, you will receive the replay link. If you don't, well, you're not going to get it. So I'm not publishing the link anywhere else. So if you don't go and register, well, then you're not going to get that information. So moosemarkets.com/webinar next Thursday, 1 p.m. Not tomorrow, but rather on the 19th. Sorry, guys. All right, so tomorrow we are going to talk about which of my top 10 holding I would be willing to be overweight, so invest even more in it. So we're going to review my top 10 holdings, we're going to discuss those, and I'm going to tell you which one I would be willing to add more capital to it at this moment. All right, Moose, that's enough for today. I hope that you will enjoy your day, and until tomorrow morning, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.